Welcome everyone. We'll just wait a couple of minutes for everyone to join. Thanks. Welcome. We'll start in just a minute or so. Thank you. I can still see people joining, so I'll just wait another 30 seconds or so. Okay. All right. We'll get started. So tēnā koutou everyone, my name's Kath and I'm the Chief Client Officer here at Fisher Funds. And this afternoon I'm joined by Robbie and Sam from our investment team. And we're going to be taking you through what's been happening in the market. Well, actually, I'm going to be asking them lots of questions about what's been happening in the market with a particular focus on New Zealand, Australia and the property and infrastructure. So Sam, Robbie and I are all in Auckland. We're working in level 3, so we're all in our homes. So welcome to all of you that are joining us from throughout New Zealand. And I know we've got teams of advisors in Christchurch and Wellington who are living up the level 2 lifestyle. So as many of you know, we offer managed funds and KiwiSavers for a range of clients. And we really help our clients to grow their wealth and achieve their goals through our trustworthy processes. And that really starts with what our investment team does. And we really work to get the very best returns for our clients. So we really welcome your questions. This is all about your questions. So down the very bottom of your screen, you'll see a Q&A. So type in your question there and we'll do our very best to answer it. I've got a few questions to start with for Sam and Robbie, and then we'll get into your questions. So just a couple of things before we get started. Your attendance isn't visible to anybody else, as well as this is information only. It's not financial advice, so it doesn't take into account your own situation. But of course, we have a great team of advisors and that can help you. So feel free to check out our website, get in touch with your advisor and contact us in any way if you have any questions. And lastly, the webinar is being recorded, so we are able to send it out. So if you don't manage to make it all or you want to revisit it, that will be available for you. So let's get started. And I can see we've got questions coming already, which is fantastic. So Robbie, I'm going to start with you. So welcome. There's been, and this is a good tough one to start with, there's been a lot of discussions recently announced around the alliance between Australia, the UK and the US, known as AUKUS, which Australia is building nuclear power submarines with the help of the US. So really interested in what your thoughts are and what that means for Australia and New Zealand.
Yeah, thanks, Kath. The AUKUS agreement is certainly centered around defense, and I guess it's in response to the rising geopolitical tensions between China and the US. And so Australia has signed this agreement to, I guess, ally up more closely with the US and the UK. I'll leave others to comment about the geopolitical significance of this and what it means from a national security standpoint. I think there are people who are far better qualified to talk about that. But an important element of the AUKUS agreement is centered around innovation, and all three countries are seeking ways in which they can invest in technology and collaborate amongst those three countries on technological developments, particularly around quantum computing, artificial intelligence, and try and integrate their supply chains more closely. And for us, that's where we have interest. We don't quite know what shape that's going to take yet, so it'll take time before that is obvious. Hopefully there are some near-term spin-offs for our Australian companies that we're invested in, but more, I guess more importantly, longer term, this will probably have good spin-off advantages from an innovation and technological development standpoint. And hopefully that results in new companies that we can invest in. But that'll take 5-10 years before we know the answer to that.
Yeah, thanks. And another question around Australia and around vaccination rates. So we seem to be, Australia seems to be a few kind of weeks or a month maybe ahead of us in terms of vaccination rates and coming out of lockdowns. So how are you seeing this impact the market there? And is there any read across for New Zealand as our vaccination rates catch up?
Yeah, well, I mean, certainly the people that I chat to in New South Wales and Victoria are fizzing now at the prospect that they are seeing a light at the end of the tunnel. I think Premier Berejiklian in New South Wales confirmed today that they'll be coming out of their first stage of lockdown on the 11th of October. So we've made, I guess from our perspective, we've made one or two small tweaks to our portfolio. We have increased our weighting in oOh!media, which is one of the largest outdoor advertising companies in Australia. And they advertise on a lot of billboards around Sydney, around Victoria, as well as actually on the sides of bus stops here in Auckland, for example. And they had a bunch of advertising campaigns from their clients which were deferred when Sydney went into lockdown. And those advertising campaigns will get reignited as they're coming out of lockdown. So we upweighted the stock in anticipation of this because we have more certainty about the recovery in their earnings profile. And conversely, we reduced our weighting in Woolworths, the large supermarket operator in Australia. We still like Woolworths and it's a core part of our portfolio. But as people move around more and get out of the house more, they will shop less at Woolworths and they'll dine out more. And so, it'll have an impact on Woolworths sales. So we've made those two tweaks, but I'd stress that those tweaks are at the edges. Fundamentally, our investment approach is to invest in companies that we think will grow and will do really well over 4, 5, and 6 years. And with that time horizon in mind, whether New South Wales is in lockdown or Victoria is in lockdown for 2 months or 3 months is not going to change the end game for those companies and the reason why we're investing in those businesses. So on the whole, we haven't made many tweaks to our portfolio as we come up to the end of those lockdowns, but those are two of them. And then bringing this back to New Zealand, I guess, it's as we head towards our reopening in whatever shape that takes, we can expect that companies with domestic facing businesses, including oOh!media with its advertising market here, in Auckland, they will tend to probably do a bit better.
Yeah, great. Thanks. Sam, I'm going to bring you into the conversation. Welcome.
Welcome. Yeah, thank you.
So talk to us a little bit about what is driving the increased volatility in the global equities markets recently. There's been a lot happening, and I know quite a few of the advisors are getting phone calls from some clients around this. So really keen to hear your thoughts.
Yeah. Thanks, Kath, and good afternoon, everyone. And Robbie did get the tough ones there, didn't he? He's been asked to be a geopolitical expert and a doctor in the space of the first two questions. So thank you for the markets one. And good afternoon, everyone. You are right. Equity market volatility has increased a little bit in the last week or two. So what does that mean? That means global equity markets are down around 5% month to date. So for the month of September. So let's not forget, first of all, that markets have had a really good run so far this year already, on top of a strong year last year. So global equities, even after this little pullback in September, are still up 14% year to date, which is a good return in anyone's books. But secondly, the market is still grappling, and we've talked about this before, with the specter of rising inflation and hence rising interest rates. So the debate is really how quickly are global central banks, in particular the Federal Reserve, the biggest one in the world, going to take the punch bowl away? And what I mean by that is, when are they going to remove excess liquidity support and raise rates? Now, one really important point on this is that is a good thing that they're doing this, because it means economies are learning to stand on their own 2 feet again after being on life support or being artificially supported for the best part of 18 months. But there will be some indigestion, Kath, as we make this transition.
Okay, thanks. And we've got a question here, which is great. We're getting lots coming through, so keep them coming, which is your thoughts on the Evergrande default and the likely impact or influence on our market.
Yes. So Evergrande, let's take a step back here. What is Evergrande? Why is it important? Evergrande is the biggest property developer in the world. It sells annually the entire residential housing stock in New Zealand every year. So it's pretty big. It's got $300 billion of debt, and it's taking up a lot of airwaves at the moment in global markets. And to your point, Kath, it already is having an impact on the markets. It directly affects and even slightly indirectly affects. So Robbie's been seeing this in Australia. Steel and iron ore prices, for example, that go into building property in China, where Evergrande is kind of infecting the market over there, are down as much as 45%. But this is really important here, Kath. It is not surprising that a property developer or any indebted company in China, for that matter, is being allowed to default on its debt. And this removal of this implicit government guarantee has been signaled for a while. So the point here is we should expect more of these high-profile bankruptcies in China. And while painful, it is a good thing in the medium term. And why I say that is, since 2012, when President Xi got into power, he has been talking about taking away this implicit government guarantee. To be super clear, what I mean by that is, if you're an investor or risk taker in China and you think that you can just continuously take on inappropriate amounts of debt and the government will be there to always bail you out and hold your hand, the debt burden will never stop going up. So this is really important. Again, a little bit like the transition the markets are going through from, full life support to standing on their own 2 feet. This could be a little bit painful, but in the long term, it's definitely a good thing.
Okay, thanks. And another question for you is, what is going on with the global, I'll come to Robbie shortly, what's going on with the global energy squeeze and what are the implications for the economy and markets, and in particular New Zealand?
Yeah, so squeeze, I assume the question means like energy prices are shooting up globally. And I think this is really interesting, Kath, and worth watching. So to give you some context there, European and US natural gas prices are up more than 200% over the past year or so. And good old crude oil is up 100% in the past year or so. And this is obviously important to all of us because rising oil and energy prices are a tax on the consumer, tax on all of us here this afternoon. So I guess why are they rising so fast? Firstly, we are seeing finally the retirement of a lot of coal-fired power plants globally as countries try and hit their carbon emission targets. Now, what that means is that natural gas is being used as a feedstock for power plants instead of coal more aggressively. So that's the first reason natural gas prices are shooting up. Secondly, I think we all want, well, certainly I want more renewable energy globally, like wind and solar. But the problem is the wind doesn't always blow when you need it most. So again, natural gas is being relied upon more heavily as a backstop in those peaking periods when wind might not be blowing. And frankly, we saw this in New Zealand recently when we saw some blackouts. The wind didn't blow. We needed to rely on our gas-fired power stations. And the final thing is, heavy carbon emitters like oil and natural gas producers are being more heavily taxed. So if you think about it, if you're sitting in the boardroom of one of these companies a year ago, the oil prices, on the floor because demand has dried up, or 18 months ago during COVID, and you are in the penalty box. No one seems to like you. You've been heavily taxed by governments. If you're sitting around the boardroom table, you're probably not going to be signing checks for big development and exploration projects to search for more supply of oil. So basically, we've seen strong demand for energy coming out of lockdown and not a lot of supply. So prices have shot up. And the final thing I'd say on that, Kath, is, and this is probably the hardest one, I'm sure you'd want to know how long this will last, how long these spikes will last, how much will this impact us at the petrol pump here in New Zealand, how much will this impact CPI or inflation. I think what I'll say on that one is I'm a big believer in the old adage that the best cure for high commodity prices is high commodity prices. So again, if you go back to those boardrooms today, I bet you they're all sitting around saying, how good is this? How good are these high prices? Let's turn on some of these wells that we turned off. Let's start producing some of this marginal gas and oil. And that supply comes with a lag, but I think as these prices go high, we'll get more and more supply. So that should calm these prices down.
Yeah, thanks. And I think you touched on some thoughts that I'm hoping that you could help us with, Robbie. A question around ESG. So what's new in the world of ESG at the moment?
Yeah, well, Kath, as you know, ESG has been central to the way that we invest at Fisher Funds for many years. So for those on the webinar, if you are interested in understanding more about what our responsible investing policy entails, there is a section on the website that you can go to information on that. But this, it's a fascinating space because it obviously, ESG is increasing in prominence across the globe, and stands for environmental, social, and governance considerations. And so we are dynamically moving and continuing to evolve our approach to it as well at Fisher Funds. So most recently, we've begun recording and measuring the carbon emissions and the carbon intensity of our equity portfolios to see what that looks like, and we can start monitoring that and make sure that we are heading in the right direction in that regard. Pleasingly, actually, the data shows that our equity portfolios are far less carbon intensive relative to the broader market. Intuitively, because we have this ESG and responsible investing policy in place, you would have expected that, I think. We certainly did, but it's pleasing to see that translate in the data. So we look forward to rolling that out for all of our portfolios, both fixed income and multi-asset portfolios over the next few months. And then secondly, at the moment in New Zealand, we do have legislation that is in the process of working its way through Parliament around the environmental requirements that need to be reported on by companies in New Zealand, and that includes Fisher Funds as a business. So it's still early days in that process. I think we'll only finalize those recommendations and finalize what that looks like over the course of the next year. But a number of us in the team are looking at that and making sure that we're staying abreast of those developments.
Yeah, that's great. Thank you. And I've got a couple of questions here, which are for me, so I'll answer those and let you guys have a breath. So the first one is, are we recording this? So someone's husband couldn't make it. Yes, we are. So we'll be able to send out a copy for you to pass on or share later on. And then the other question is 11 years too short a time to have a managed fund if you're putting in something like $100, $150 a month? And so not at all. 11 years is a great time to have a managed fund. And in fact, as we know, with the sooner you start on the journey, the better. And I've actually got my kids with managed funds, they're putting half of their money that they earn in, and I know that they're going to be looking after me in retirement. Actually, that's the plan, I think. So yeah, that's never, any time's a good time. We do have timeframes that our team can help you with in terms of the minimum amount, but 11 years sounds pretty good. So I'm going to hand over to you, Sam, actually, and I'm going to go a little bit more around the Property and Infrastructure Fund. And so you've talked before about how you think about infrastructure differently within your fund, within the P&I fund. So tell us what you mean by that. How do you think about it differently?
Yeah, thanks, Kath. I guess probably the easiest way to say that is, if you think about conventional wisdom around infrastructure, it's pretty boring, sort of backbone of the economy type assets like, I guess, toll roads or utilities. How we think differently, Kath, is we're kind of hunting that rare beast, which we call growth infrastructure. And the reason I say it's a rare beast is we still love the downside protection that infrastructure gives us, but we want some of the upside as well. So there's several ways to get that upside, but one of the ways we've found the easiest is by investing, and when I mean upside, I mean the growth. We don't want boring GDP type assets. We want that downside protection. We want some really decent growth. So we invest behind secular mega trends. And one of the easiest ones to talk about is data proliferation. So if I sent everyone here on the call tonight a 1-minute video clip, that would use 600 times as much data as a traditional text message. So we all know it, we're all hungry for it, our children are all hungry for it. And American Tower, which we own in our P&I fund, sells space on its cellular towers to the US telcos like AT&T and Verizon, who in turn sell the in-demand data to consumers in the US. And American Tower and Crown Castle, its sister company, which we also own 82,000 of the 130,000 cellular towers in the US. And because of, no one likes to build a cell tower in their backyard, it's really hard to get consent. There's only about 1,000 of these towers built a year. So they've really got a stranglehold on that market or a wide moat. Now, the final point I'd make is the downside protection we get here that I talked about before, which we still love from infrastructure, is every time AT&T hang a piece of equipment, 3G, 4G, 5G equipment on AT&T's tower, they get a 3% guaranteed minimum rental growth per annum. So that's your downside protection. The upside, though, is AT&T needs to hang more and more and more equipment on American Tower's towers to slate this data demand we talked about before. So actually, these companies grow more like 10 to 12%. So that is kind of a rare beast.
Yeah, okay, thanks. And The other thing around the P&I fund, while we're on that, is global interest rates have moved up quite significantly from November last year. So how does the P&I fund perform in a rising rate environment?
Yeah, and I assume the question's referring to November being the date when several global pharmaceutical companies came out at the same time in a sort of a 24 to 36 hour period and all talked about 90% plus vaccine efficacy. And that sparked that global rise in interest rates, Kath, you're talking about. So if we use the US 10-year bond as just a proxy for global bond rates, that's gone from 0.8% back then to around 1.5% today. So big rise. Since then, the P&I portfolio is up about 25% versus the benchmark of up 19%. So decent outperformance, although this is slightly less than global equities, up 30% plus. But it's worth remembering this fund can give good downside protection, which we were talking about before. So if I give you one example there, it seems like a long time ago, but remember back to September, October last year when the S&P 500 and the NASDAQ fell 10% or so over 2 months. Over that time frame, the P&I fund was actually up. So while it may not give you the biggest returns in a bull market, we think it's got a really important part of any diversified portfolio.
Yeah, and actually I've been thinking we've got quite a few people here, Sam, that potentially don't know a lot about our fund. So can you explain a little bit about what P&I stands for?
Yeah, sure. Sorry, I did really rush into that. So P&I stands for Property and Infrastructure. It's primarily global infrastructure. And we do have some of that sort of backbone type infrastructure. So we own, Transurban in Australia, for example, which is one of the biggest toll road operators globally. But we have a sort of a split between that sort of backbone type infrastructure and the more growth aspect I talked about before. And at the moment, that's split probably 65% towards growth assets, like the towers, like our US rail assets, like our childcare REITs in Australia, and about 35% towards that sort of downside protection, sort of more bond-like assets. So it's a global fund, invests in property and infrastructure, primarily infrastructure.
Okay, that's great. And I'm going to ask you one more question and then I'll give you a break and start bombarding Robbie. But Auckland Airport, I'm hoping to get there sometime when we can travel again, but it's been hit with a slew of bad news. But why has it held up so well?
A slew, yeah. I mean, it's been a laundry list of bad news, Kath, hasn't it? So, what is that bad news, the slew of bad news that Kath's talking about? We've had the stop-start Trans-Tasman bubble. We've all heard about that. We've had the pending departure or the announced departure of, highly respected CEO Adrian Littlewood. And we've had, on top of that, we've had kind of a slew of near-term earnings downgrades from, the sell-side consensus. And that's enough to make any short-term bear lick their lip. But the stock is flat versus where it started the year. And that's really encouraging because it means investors are focusing on the long-term picture. So what is that long-term picture? We will travel again. There you go, Kath. You're desperate to travel. And when you own, like we do, a long life critical infrastructure asset, looking at the long term is exactly the right thing to do. And over Robbie's side of the fence, that's exactly what the bidders for Sydney Airport did. These are sophisticated global infrastructure investors. They run hundreds of billions of dollars, and they took a long-term view and looked through this 1 in 100 year COVID event. And if you think about it, that Sydney concession runs for another 76 years. So I'm sure when those investors look back in a few years' time, COVID, while severe and very unfortunate, will look like a blip.
Yeah. Well, hopefully I can get there. I'm planning to go visit the team in Christchurch first, the advisors, and my parents while they're there. Okay, so Robbie, I think we might be asking you, someone here is asking you maybe to be a little bit more around than investment, but anyway, here we go. So Australia secured a trade agreement with the UK, New Zealand has not. Damien O'Connor is off to Europe to hopefully secure a trade agreement with Europe. If unsuccessful, how does that look for New Zealand? You can do the no comment if you like, but
yeah, that is an interesting one. The the UK I think, is very incentivized to get trade deals done, having exited the EU. So I think the pressure is probably more on the UK side of the fence than it is on ours. But hopefully they can get something up. It's probably not a complete train smash near term if New Zealand doesn't secure something, because the UK is not our largest trading partner. You know, we are very focused from a trading partner perspective on China, Australia, the US, and so on. But yeah, in short, hopefully they do get something up, and I'd say the pressure's on the UK there.
Yeah. And what do you think about coal mining shares in Oz with China reducing its use?
Yeah, well, it's you know, we, as I mentioned earlier, we do have a responsible investing policy in place. So from an investment standpoint, we don't invest in thermal coal mines or companies that specialize in thermal coal. That's on our prohibited list. So it's not a sector we look at all. It's not a sector we particularly like. So we welcome China's reduction in use overall of thermal coal, but obviously it will have a negative effect on the thermal coal sector in Australia. But that doesn't flow into our portfolios at all.
Yeah, thanks. Okay, so I'm going to go back to you, Sam. Yeah, only had a short break. So some questions here. A lot of successful New Zealand companies are moving offshore, like Xero and Rocket Lab. Are there still enough companies to invest in on the NZX?
Yeah, I mean, the answer is yes, there are. We don't like seeing great companies go offshore. And to be clear, we still consider Xero to be a New Zealand company. Why is that? Born and bred in New Zealand. It's got a large proportion of its team, you know, its employees based here. It's got its head office in Wellington. It really is a New Zealand success story. So just because of the fact it's listed in Australia doesn't mean, you know, we'll necessarily put it into Australian funds. It's in a New Zealand fund. Yeah, in short, we'd love to see more New Zealand companies listed here. There's a few listings coming up, which we'll be having a close look at. But yeah, I mean, it seems to be the way of the world at the moment.
Absolutely. And I guess for both of you, a question that's come up from a couple of questions as I'm looking through is actually, given the media dialogue with regards to passive versus active management, can you really give us an example of how Fisher Funds adds values for investors? And so we're obviously active investors, so maybe explaining a bit more about what that is and how that benefits our clients or, you know, people that want to join Fisher Funds.
I'm happy to have a crack at that, Sam, and follow on if you want to add to it. Well, what active management from a Fisher Funds perspective entails is that, you know, if there are 40,000 globally listed companies on stock markets around the world, we don't invest in a broad swath of them. So we filter using our STEEP process, which is a very well-defined process at Fisher Funds, where we look for companies that meet a set of quality and growth criteria. We filter that down to select hand-picked companies and put them into our portfolios. So for example, if I think of the Australian equity portfolios, which is the team that I'm involved in, we have 25 Australian companies in our Aussie portfolio, despite there being 200 companies in the index, whereas passive investors would invest across the index and invest in all 200. So that's the first thing. We select the highest quality hand-picked companies to put in our portfolios, and over time we add value by having those companies deliver returns that are better than the returns that you can get by investing across the market. And, you know, we've at Fisher Funds, we've been in business now since the late 1990s, and the New Zealand Growth Fund, which is our longest running fund at Fisher Funds, over that time frame has significantly outperformed the New Zealand market benchmark index. So it's, I guess, tangible demonstration of the fact that we do deliver value by selecting these companies and carefully curating our portfolios, and it's delivered huge outperformance for our clients and investors relative to what they could have got if they'd invested in passive funds that by and large invest broadly across the market.
Yeah. Sam, is there anything you want to add?
No, I was just going to say I love Robbie's passion there. I mean, that is why we come to work. We're very passionate, active investors. We come to handpick and beat the market.
Absolutely. Great. Okay, so I am going through here to ask some more questions. So I'll ask myself one while you have a break. So a question around, I'm looking for a more conservative investment. Do you have conservative income funds? And yes, we do. So we have a range of funds, and the best idea is either to talk to your advisor or give us a call if you're not sure who that is, or you're new. You can check out our website and complete an investor profile questionnaire, which gives you an idea about where your risk lies and how you perceive things around your investment. And from there, that can help guide your decisions, and the team here is happy to help. So that's me answered one of those questions. We've got lots coming in, which is fantastic. Sam, I'm going to ask you one around, which is a little bit, we've seen a lot of, particularly with COVID recently, is the upsurge in cyber attacks internationally have exposed many company security arrangements. So is this something that you look for or taking into account when you're investing? And, how do you work that in when you're looking at companies?
Yeah, no, absolutely. I think it's clearly a very big risk, not just for companies we invest in, but for Fisher Funds right here. And I think we've got an excellent cybersecurity policy at Fisher Funds. So we actually do speak to our head of IT there and school ourselves up. But where this comes into effect is we've talked about STEEP before, which is our process or our framework by which we invest in companies. It's a clever acronym. The first letter of that is the strength of the business. And within that, we talk about moats, how wide the sustainable economic advantage is, sustainable competitive advantage, but also we talk about business risk. And within business risk, absolutely, we're super focused on the IT infrastructure these companies have, and it's becoming a bigger focus for us.
Yeah. Right, thank you. Oh, Robbie, I'm going to ask you this one. You're going to love me for this. So what's your team's take on cryptocurrency?
Oh, it's a question we do get, we have got quite regularly over the last few months. When we look at it, at all of our investments across our portfolios, fundamentally we're looking for businesses that do that do have the capacity to grow, and that have a moat around them that we can understand, and that deliver profit growth over a long period of time. When it comes to cryptocurrencies, it's a very interesting space. It's clearly developing fast, and will have a potentially a big impact in the way that we transact and the way currencies, the way that people transact when they buy things and move money around the globe. But from an intrinsic standpoint, crypto doesn't deliver a return itself. So for us, in terms of our investment process, trying to figure out what the earnings potential will be with any of the cryptocurrencies doesn't really fit into that framework in the first instance. In the second instance, though, crypto, if we think of currencies or forms of wealth that have a store of value and don't deliver earnings, there's generally, you need to be able to assess what that store of value is. And again, there are people that spend their whole time kind of analyzing gold and trying to understand what the store of value of gold is. That doesn't, again, fit within our investment process per se. So we don't have a huge edge in investing in gold, and so we consequently also don't have a huge edge in investing in cryptocurrencies. It is something that we debate intensely because it comes up from time to time, but crypto doesn't form part of our portfolios at the moment. It's a space that we're interested in learning more about, but it's not part of our KiwiSaver portfolios right now.
So something kind of a little bit extremely different from crypto is the housing market, and this is for you, Sam. So are you worried about our New Zealand's housing prices, and is this a risk to our economy?
Yeah, I was just musing on your previous question. Actually, I was thinking, Kath, when you're saving up to go overseas for this trip via Auckland Airport, you're eventually excited about. I think you'll probably take into account, you might not put your money or your savings for your overseas trip in Bitcoin because it's 11 times more volatile than the average currency, and it can fall 30% in a night. So you might think you're going to Hawaii, but end up going to Palmerston North, which is where I'm from. I'm near where I'm from, actually.
I'm glad that you added that little bit in, Sam.
Yeah, no, I'm from Waverley. So it's Palmerston North was the big smoke. The New Zealand housing market, it's obviously a question we get a lot. affordability is clearly become stretched in New Zealand. It's become stretched in all OECD markets, but New Zealand is probably leading the way in affordability or lack of affordability for housing. The Reserve Bank seems fairly clear that it wants to dampen down the enthusiasm in the housing market. I don't think for a second they want a correction in the housing market, but I think they'd probably be happy if they could make it go sideways for 2 or 3 years at least, so that incomes could catch up and we could get that affordability ratio up, which is kind of what we saw, I guess, I'm thinking the peak was sort of August, September 2016 through 2019. We did see a sideways chopping housing market and incomes rising, which means that affordability healthily improves. So if the RBNZ can achieve their most desired outcome, I think that's probably a reasonable scenario.
Yeah, that's good. Okay, I'm actually just quite keen to go to Christchurch, as I said. I'm not even needing that big overseas holiday yet.
Well, you can invest in crypto then, Kath, because
Okay, well, I've got a question here, which is for me, which is around KiwiSaver. I have a KiwiSaver with Fisher Funds. I have some money to invest. Should I add to my KiwiSaver or separate? It really depends on what you're looking to achieve, your age and your circumstances. So suggest you give us a call and we'll be able to help you out with managing the best way to do that. So we've got lots of questions coming through, and I think we've got time for at least 3 or 4 more. So either of you, does Fisher Funds have any investments in the BNPL sector, like Afterpay, Lay-by, etc.? And if not, are we looking at these kind of high growth in the future?
Yeah, well, a lot of those companies that were mentioned there are or have been listed in Australia. It's not a sector that we have an exposure to or are invested in. It is a very high growth sector, and I mean, Afterpay have done a fabulous job in building the business to the size that it is. From our investment standpoint perspective, we have a number of quality criteria, and one of them is having some form of earnings history. And a lot of the likes of Afterpay, these buy now, pay later companies, are still very early stage and loss making. That doesn't mean that there won't be successful investments, but a lot of them are just too early stage for us to contemplate investing in given the makeup of our investment process. Then linked to that is, as part of our investment process, we always try and figure out what the moat is for a company, what its durable competitive position is. And when we look at the likes of the buy now, pay later sector, it is quite tough for us to look and try and understand, while they're doing well now, what is the special sauce that will enable them to retain their growth and their margins into the future. So there are a whole lot of players that are entering the space. PayPal is going into the segment as well, and so trying to determine what that moat is quite tricky in a fast-growing, diverse sector like buy now, pay later. So I guess for those reasons we're not invested in it, but kudos to those companies; they've done really well.
Absolutely. Sam, A2 Milk. Can you have a chat to us? How do you see its performance and what's been happening there?
Yeah, I guess performance is disappointing, very disappointing, obviously. I think maybe not to give the full checkered history, but just to give you a really brief rundown on what happened. We all know this was an incredible Kiwi success story, went from no revenue in China to $1.5 billion in revenue in 5 years. So by any measure, incredible success story. And perversely, its fall from grace, its severe fall from grace, started with very, very strong demand. So you wind the clock back to January, February last year, and Chinese mothers were concerned that supply chains were going to lock up and they weren't going to be able to get their quota of A2 Platinum, the key product that A2 sells in China. So they started to stockpile that product. And if you think about how stocking cycles, inventory cycles work really, really quickly, is if you typically keep 1 or 2 tins of A2 milk in your pantry in Beijing, Shanghai, Shenzhen, as a mother, and all of a sudden you panicked and thought, right, I'm going to keep 10 tins in there. The producer A2 doesn't know. All they see is this big surge in demand. And if you think about that, that's a 500% surge in demand. Then, as it turns out, There's lots of layers in the supply chain for A2, all the way from Dunsandel down in Christchurch to the ports on the ships, to the master daigou in Australia, the supermarkets, the free trade zones in China, all the way to the mother in Shanghai or Beijing. And everyone felt that surge in demand. So that's one mother going from 2 tins to 10. Imagine timesing that by millions of mothers in China. And there was this huge surge in demand. So everyone thought, right, there's a really strong underlying demand for this product. So every layer of that channel stocked up. But all of a sudden they realized they could get the product. So that mother in Shanghai, Shenzhen, Beijing, Xi'an suddenly said, I only need to keep the original 2 tins in my cupboard. So imagine what that feels like as a producer all the way back in Christchurch. It feels like your demand's fallen 80%. So if there's 500% surge in demand, and all of a sudden your demand feels like it's fallen 80%, and that reverberated through that entire distribution channel. And we had, many, many months of destocking that excess stock all the way through the channel. And, our view on the company really started to change back in sort of October, November last year, when we thought originally it was just going to be a temporary single channel logistics issue, driven by COVID. But then management made a series of missteps, didn't diagnose the problem quick enough, and didn't solve the problem quick enough. As it turned out, the key architect of the great success story, who probably hadn't been quick enough to the breakdown, left the company. We got a new CEO. And now, the jury is still out. And I guess, where do we sit now after changing our mind back in October, November last year? Is the easiest way to put it is, you would normally expect a long-term investor like us to be, really stepping up to the plate and buying a company like this that has fallen, a long, long way. But as it turns out, we're still sitting there with a very small position on the sidelines, waiting to see how this develops.
Yeah. Great. Well, there's so many questions coming through. I think we've got time for a few more, so I'm going to answer some myself. So how many advisors do we have? We have 3 advisors in Christchurch, 3 in Wellington, and we have a whole lot in Auckland now. So I think we've got 22 in total. So another question that came up earlier was, can you look after me rather than someone else? And we've got you've either got an advisor, which is good, or if you don't, then give us a call and one of the team can help you out. So there we go. A question for you, Robbie, couple more here. What about EV companies like Tesla? Where do we see those going?
Yeah, it's the EV that's a massively changing space. So it's, again, when we think about moats and competitive advantages, the automobile manufacturers like Tesla are doing quite well, but there are a whole host of them competing in that market. So trying to guess which ones are going to succeed is a far harder proposition than knowing that EVs are going to be a thing of the future. But we do, in our Australian equity portfolios, we have got exposure to a company that is doing some pretty innovative work in the EV space. There's a company based up in Brisbane called PWR Holdings, which is involved in developing very specialized cooling products, effective mainly for Formula One cars. So they provide cooling products to all of the Formula One teams. And as part of their emerging technologies division, they've been doing a lot of design work with companies around EVs, ranging from companies doing, figuring out EV technology for cars, through to truck manufacturers who are looking at hydrogen and fuel cell innovations to put into trucks, as well as they're doing work with 6 different helicopter manufacturers that are looking to develop the first EV helicopters and providing the cooling systems around that, because EV technology does EVs tend to throw off a lot of heat, and they've got some very specialist proprietary intellectual property around that. So it's that's a pretty exciting development. This company, over the last year, its emerging technologies revenue has doubled. It's gone from $5 to $10 million, and that's going to double, we think, over the next couple of years as well, and keep going. So it's very strong growth runway, and it's, I guess, involved in that EV market, but with a good moat around the intellectual property that they have in that space.
So have you put your name on the wait list for the helicopter, Robbie?
I'll put my name on the wait list for the helicopter ride. So yeah, absolutely. They're going to try and trial these rides between LA and Las Vegas. So if I can get over there, Kath, that sounds like a site visit I have to do.
Absolutely. A question, I guess, somewhat related to that around energy is Fisher Funds interested in battery technology that competes with the lithium battery, for example, Redflow in Australia?
Not specifically. Again, a lot of before we'd invest in pioneering technologies like that battery technology that Redflow is involved in, we'd need to understand what the moat is and really have confidence that a company has developed something that is in high demand and has a strong, durable competitive advantage around it. So we haven't yet made an investment in that space, but as I say, we are invested in PWR Holdings, which is I guess has got technology in the EV space, and to the extent we find other companies like that, yeah, we'd be really interested in it, because that sector has a bright future, I think.
Yeah, I just add one thing to that, Robbie, is I totally agree, is these early stage or emerging technology companies are really, really exciting, and we all love to think we can pick the next 10-bagger winner. Our process is not really geared towards that. It's actually to invest in companies that have already won. And a great example of that is Google. It was pretty obvious, probably 15 years ago, that Google had won the search space. Yahoo was gone, all of those other search engines we all remember using were gone, and it was already clearly the winner in the space. Yet it's been a 17-bagger since then, and so it's gone up 1,800% since then, once it was already clearly a winner.
That's a really good point, Sam.
Yeah. So one final question, and that's what either of you or both of you can answer to finish off. And does Fisher Funds follow Warren Buffett's value investing school of thought, or something else?
Yeah, we love Warren, by the way. We often quote Warren. In fact, we were just quoting Warren the other day, saying that be fearful when others are greedy, in relation to some of the fear we're seeing in China. But we are a growth investor as opposed to a value investor. Having said that, as Robbie often says, we build all-weather portfolios, so we won't be just all in growth. For example, within the New Zealand portfolio, Mainfreight would be considered a value stock. It's a cyclical trucking company, and does participate in value as well. But we love Warren. We've just got a slightly different strategy.
Fantastic. Anything you wanted to add to that, Robbie, or are you happy with that?
No, it's yeah, I guess where we do overlap with Warren is finding businesses that do have big moats around them. Sam mentioned Google, and Warren certainly is focused on that. So yeah, we're not investing in businesses that we find with 15 times PEs, because there are not that many of them around in this market, certainly in the quality and growth part of the market. But we do try and find businesses with characteristics that he searches as well in his investment process.
Yeah, fantastic. So thanks so much for joining us, Robbie and Sam. That's been fantastic. And we've had a lot of questions. So please, if we haven't got to your question, we will get back in touch, or feel free to contact us here at the team. And one of the great things I love about Fisher Funds is that we talk regularly to the investment team, the team of advisors, so we can always find an answer to your question, hopefully, and help you with that. So thank you very much. Have a lovely evening, and thanks for joining us again. See you later.
Thank you.
Thanks.